Hi, everyone. How's everyone doing this morning? Turnaround Tuesday. Nothing I see I want to fade right off the bat. Everyone doing okay? So yesterday I was talking about the trade was a short up here, and that doesn't mean that I take the trade for a long in US dollar yen down here. Anyway, it's heading up towards that area. Keep in mind we have NFP. Hi, Shahab, Brock. We have NFP on Friday, and dare I say it, I believe a lunar eclipse on Friday or Saturday, another eclipse. And I'm suffering from an eclipse of the heart. So anyway, guys, looking at this, if we had yen strength into the number, I'm thinking this could be a pretty good fade. I was long euro Friday and got out, and I'm not sure. This is a decent day to buy weakness because euro is not as weak as cable, and EG looks like it thought it might work a little bit lower, still could, but hasn't given up much. And if we're headed up, that makes your preferred long the euro. You know, I don't know why we couldn't get back towards this level. This was kind of a major breakdown, this 87.80, 88 level. And this looks like a decent daily candle, although it's very early. Want to show silver. So silver was weaker than gold yesterday on the pullback, and there is potential that maybe we have a right shoulder developing here, and it held the 1790 level. Under 1790, I really think we could see, I was talking about 1740 last week. That's actually what the measured move would be. 60 would be more like 1730. See if we have any daily moving averages here. And, you know, I'm not ruling out that it can't blow one more time. There were some short-term confirmations at the high on Monday night when we spiked, but on other time frames, you know, pretty glaring divergence between this high and this high and this high. Ziggy's jonesing. Okay. All right. All right, Ziggy. Stop doing that. I already read my email. Well, I'm going to have to adjust that. Oh, Steve's dealing with a flood. Yeah, poor guy. So I wanted to look at yields here because so far we're holding, right? So, you know, it still hasn't resolved itself here at all, right? So we still need 173 for a breakdown and 198 for a breakout. This is going to measure 230. This is going to take us down to new lows. It's a coin toss. I favor one more decline in rates to take out these lows and make new historic lows on the 10-year. We'll see if that develops. I think we're going to need an S&P correction for that to occur, you know, some flight to safety in there. And looking at the S&Ps, I know the guys are talking about 3,300 is, like Blake was talking about, 3,300 is 1.618 of that big decline. So far, we have a lower high, and NAR just charted an RSI chart showing this RSI uptrend from here to here. And I said, if we make a new all-time high up here, and I have some return lines all the way up here, will the daily get it? Yeah, it looks like it's up here around 3,300. The RSI will not make a new high, I don't think. And this is turnaround Tuesday. So if I were to take a shot, Zig, You could short the S&Ps with stops over today's highs and press it under 30, this low, under this low, 3208, then we're headed towards 3158, 3160. So this could turn into, the first failing rally in a while. So if that happens, I think that's what's going to take the bonds to new highs and in price, and 10-year notes to new lows in yield. So you need that. Crude faded yesterday. I mean, it was pretty classic 3 drive, don't you think? Let's see. Here's the 1 hour. 1, 2, 3 pulled off. But, with what's going on there, I can't get short. And I have a hard time wanting to buy it too. So I just scalped it. In fact, with the backdrop of geo stuff, I know Mark yesterday said, we always magnify it, but, I don't know. This stuff was, we were rallying before, but it certainly got magnified after the assassination of the Iranian general. So Zig, I think that's the best shot I see for a turnaround Tuesday trade is trying to fade the S&Ps. People have been beat up trying it, and basically you're saying we're not going to make a new high. So, they have micro minis now. They have micro S&Ps. So you could actually have a position on and, risk 20 handles and it's not going to blow you up, right? So that would be my call, turnaround Tuesday reversal. But I also think could see it, going to the numbers the guys were talking about as well. That's why, like Blake and Steve say, the only thing we could control is our risk. So make sure you define it and make sure you put the stop in. Don't use a mental stop, right? Because mental stops will have you on a trip to the mental institution. That'll be your first stop. So that's about all I see. Steve was talking about crypto trying to come out of these levels, and Bitcoin's acting okay. So I didn't draw the wedge. This could have been a 1, 2, 3, or maybe we just have 1, 2, and we need one more washout in Bitcoin. So that's all I have for now today. And really, guys, keep some powder dry for the NFP. Could be an inflection point as well because of the astronomic event happening on the same day. So I don't know if Blake's available. Stell, are you with me?
I'm here.
Oh, okay.
I'm here. Yeah. It looks like Steve was dealing with some personal issues. So,
yeah.
If,
the pride of ownership.
Yeah, exactly. It looks like he's dealing with a flooding situation, which we had a water heater go out recently, and I know it's not fun. So anyway, let's go ahead and
I will be here, Blake.
Oh, okay. Well, Steve, go take care of your stuff. We'll just come back in 20, 30 minutes or whatever. Okay. Okay. All right. So it looks like Steve is going to be here, but
buying this dip in here, Blake.
What's
are you gonna wait for Euro to pull back to that blue line maybe one more time?
You know what? Down here, I picked it up at the 50% retracement today. Okay. I got hit on a bid at 111.65 overnight. Or 68. Sorry, I had a bid at 68. I think. Okay. Take a look at my prices. Yeah, I had a bid at 68, and it was playing out all right, but really we need to get above 111.90 for it to turn bullish. The cable's heavy, and the cable's trading right into what I consider triangle support here. So I think the cable's got to finish doing its thing before the euro can firm up.
Looks vulnerable. Is it because of what's happening over there? I'm sure Stell knows. that he has all the votes he needs, Boris?
They were talking budget this morning. I think the cable's just. I think the cable's just. I think this is more positioning than anything. I think the market was getting kind of long cable over the last several weeks. So I think you're seeing some of that positioning square a little bit. I don't necessarily think it's a. Hold on, really quick.
What if it breaks a green line on the triangle?
Hold on, really.
Yeah, go ahead, buddy.
No. Well, if it does, then we're gonna see 130. So if it breaks this triangle, then that means we're coming down here.
Okay.
What I would think.
Very important support.
Yeah. So I want to see it supported here. I'd rather it hold the 131 for a couple of reasons. Obviously, being long the euro dollar, I want to see it be supported here. But I want. Because if we sever through 131, that's going to bring in dollar strength, which is going to take the euro probably down towards 111.50, maybe, something like that. So I'd like to see this support hold, but we'll see. I think more of this is going to have to do with the ISM versus anything. So, the low today is 131.02. I've got a bid just below the market here at 131.95, but I don't know if it's going to get triggered or not. I'm hoping it will, but just because I hope it will doesn't mean it's going to. You know what I'm saying? So no, a couple. You're seeing the dollar actually make a move against a lot of different things. You got the Aussie that's actually come down quite a bit. The Aussie. This is our chart of the day yesterday, and if you traded the Aussie to the short side after we broke this trend line, which came at 69, let's just say roughly 69.20. You can see it right here. That breakdown, yielded you about a 40 pip move. And we're coming into the 618 retracement, which I thought we would test, which will be 68.59. I actually think that the dollar will lose some of its luster once like the Aussie hits, the support, the pound, drops down to 131, which we pretty much did. And the euro is already fairly well supported. So now the dollar from here, how it's going to react from here is probably more to do with the ISM data that's being released at 10 a.m. Eastern. I think that's going to be the market mover today. Remember, the ISM manufacturing data came in really weak last week. So today's services data is going to be very important for the dollar and how the dollar, responds from here. And so that's just kind of what I'm thinking right now. The Kiwis, trading a little heavier as well alongside the Aussie, but you can see the Kiwi is just testing really the big, this is a big breakout point right here. And, so the Kiwis, near support, the pounds near support, the Euro's I think the Euro's very well supported considering the dollar strength that we've seen in the market against some of these commodity currencies. So, and I sent out a tweet just a little while ago about the euro dollar. Keep in mind, guys, the euro is, we're well above this 200-day moving average. And now the 200-day moving average comes in at 111.40. So if the data, now let's talk about ISM today, and let's talk about, what's possible here. Let me launch Data Flash. Let's see if the ISM is up there yet. So we're gonna have the Data Flash will update as we get closer towards ISM. So I'll go to Forex Factory here. So the ISM data that we have, we're looking for 54.5. All right. The market is looking for a beat. And so if the data comes in, I would say above 54, remember above 50 is just still expansionary. So it's still a very strong, services read regardless of what comes in, unless we, for some, crazy reason, we drop below 50, which isn't going to happen. But let's say we print around 54. I think the market's going to see that as relatively bullish for the euro. So the euro dollar, because of that, we could actually see 111.50, maybe 111.40. But keep in mind that 200-day moving average is at 111.40. There's a channel support right there as well. Loose base channel. You can draw this channel. It's probably more like this and like that. All right. But channel support's going to be down here. And like I said, you're going to have channel support, 200-day moving average. We continue to make higher lows. So any dip down towards 111.40, I think, is going to be very well supported today. And so I want you guys to think about that in case the dollar does strengthen following the data. You might want to, use that as an opportunity to be on the long side of the euro. I still think the euro is a buy on dips type of situation. I think you want to be a buyer, down here, 20 pips lower than here if you can get it. Now the flip side of that is, let's say the data is really weak. If we break above 111.90, above this trend line right here, then the euro is probably going to rally back towards the 112, 112.20, 112.30 level. So just think about that going into today. I believe that you still want to be buying euro on dips or selling the dollar on rallies, if you want to look at it that way as well. We are seeing a rally in the dollar against, like, let's say the US dollar Norwegian krona, the US dollar Swedish krona. We're seeing those push higher right at this moment, right into some pretty key resistance levels. So be careful with the dollar. If you're out there buying dollars, shorting the euro or you're shorting the cable, just realize that we're closing in on some pretty good resistance levels for the dollar, across the board. One of the other big ones, and I know I haven't talked about the dollar yen yet, is the dollar yen. We have rallied back as I expected yesterday. I told you guys I was expecting a rally back in the dollar yen. We have stalled at the 38% retracement since yesterday. This 108.50 level has really held. It's really held this far. So, any weak data should take the dollar yen back down again. But the flip side is if it's a really strong number, let's say it's well above 54, maybe closer to expectations, above 108.50 might open up a move towards 109 again. So the dollar yen still is also at some pretty key resistance levels as we go into North American trade. So like I said, the dollar is up against a lot of resistance right now in different pairs. The dollar index is just consolidating. We're just consolidating recent losses. I have to take a look, the longer term view of the dollar. Let me get rid of this blue line, because this might make it a little bit more clear of what I'm looking at. All right, here's the dollar. And if you think about, since June of last year, so 6 months, the dollar was in this upward sloping channel, right? We broke below that, a couple of different times. We probed below it. Now we're just kind of holding below it. And this is a bearish consolidation in the dollar. So, when you look at the euro and you talk about the euro's above the 200-day moving average, well, the dollar index is well below the 200-day moving average as well. And just like the euro's consolidating those gains, the dollar is consolidating these losses. And I really would have to see a move back above the 200-day moving average to turn bullish the dollar, because if that happened, it would be something like this. Let me change the colors here. Okay. It would look something like this. a move above the 200-day moving average would be above like a descending wedge. And then, at that point in time, I'd have to turn more bullish the dollar just in general, because that means it would be a false break outside of this channel. But I actually think that the dollar is just giving us this bearish consolidation for now. That's why for now I buy dips in the euro dollar. I'll buy dips in the cable. If we can get a a little bit further dip in the cable, I'll probably pick up a little as well. One of the other things that I mentioned yesterday is and talked about today as well, even on Twitter I mentioned it, is gold. There was this and actually Helene might be listening in, and she might reference this this article that she had posted on Bloomberg, which I found very interesting, because it was some staff journalist that I didn't even recognize his name, but some Asian staff writer that was mentioning that gold was overbought, and we hadn't seen the relative strength at these levels for whatever. But if you look at the daily RSI, gold relative strength has been overbought here like this at these levels, and I think we've actually been higher than that, than what we're currently registering as of yesterday. Let me move this. I can probably draw it. I was going to draw it like that. Okay. You can see relative strength has been actually more overbought in February of 2016, back in September of 2010, and then also as recent as the summer of this last year, which you guys probably remember what gold was doing at that point. Gold was just absolutely ripping heads off this summer as we blew out this big inverted head and shoulder pattern. So and you can see by my charts, I'm still looking at 1700 in gold. Yes, it is consolidating these gains, but I have to admit, while we're above this 1550 level, and I know we're at 1565, which is not too far away.
It tried to fill the gap, Blake, couldn't quite do it. Maybe you could look at the weekly RSI pattern just for, devil's advocate.
Just a reference where we're at. Yeah, I mean, it's divergent now, but just because relative strength is divergent now doesn't mean it will stay divergent. You know what I mean?
Oh, sure. Yeah, sure.
Right. And so that's something that, we have to think about that. Like, let's say, and I'm being very theoretical right now. Let's just say some craziness happens, and gold blasts up to 1700.
It'll still be diverging.
Well, it could be divergent.
Oh yeah.
It could be, or it could actually break highs.
Yeah.
And then confirm the move, and then pull back, and then then in essence we'd see a pullback in price, and that would give us another opportunity to be long. So a lot of things can happen. I hate to prematurely write off gold and say, oh well relative strength is divergent right now. That doesn't mean it's going to continue to stay divergent on a weekly basis.
Sorry to interrupt, but the most important thing is that you never see RSI readings like that in bear markets. So yeah, can it sell off because it's overbought? Absolutely. But does the fact that we're hitting above 80 in daily RSI again and again indicate that we should be bullish or bearish? I think the answer is quite clear, right?
Yeah, that's it. Exactly. You just got to be buying on dips. When you can find dips, you got to be a buyer.
And very good example. You went back in time. Just look at how many times during that bull run it hit these kind of RSI levels, because that's what very bullish markets do. I mean, they keep hitting very overbought levels. They square off the overbought conditions by consolidating in time or correcting lower in price, and then they hit very overbought levels again, and rinse and repeat, right?
And rinse and repeat. And if you ever want to see what divergent relative strengths do, just go look at the S&P for the last 10 years.
Yeah, exactly.
Right? I mean, that's probably the best way to use a relative strength analogy. But I think you're exactly spot on, Steve. We can see pullbacks while we're in this bullish market, but we are in a bullish market. And just like the S&P, the S&P, warn people, don't get too bearish while we're above these trend lines here. I still think a move to 3,300 is possible in the S&P, up to the big golden fib of the sell-off that we saw in 2018. We're still just a rock throw away from that level, and I think it's still very doable in the S&P to get up there, despite the divergent relative strength and the overbought RSIs. So anyway, but that's a completely different story. But going back to the FX market before I turn it over to Steve, I just want to say that in the euro, we're down a little bit today. I sold. If you use ForexAnalytix, we actually have no active patterns in play. I closed the euro dollar pattern in play yesterday when it was at 112.04, and I took my euro longs off there. I've been buying these dips this morning. It's not a pattern in play because there's really no pattern here. A lot of people like to let's talk about what are closed patterns in play, which, by the way, these are all it goes back all the way to the inception of ForexAnalytix. So you can go back through every trade, every pattern that we've ever put out.
Back to July 2016.
There you go, since 2016. So you're coming up on 3.5 years of data, but you can go back through every pattern that's been initiated. One of the things that I just wanted to mention about that is, just because I have not put on a pattern in play doesn't mean that I don't trade. I take trades for a lot of different reasons. I take trades whether it's, I see, double confluence of support because we're at a 50% retracement and a trend line, or, I see a, golden fib and I want to reverse it at the 161% extension. And it coincides with 127% extension. So I want to fade, some strong move. I do trades like that all the time. But a pattern in play, when we have them on ForexAnalytix, we reference them as like by the book type of, setups, because you can see, and just going by the closed patterns in play, you can see like the average pip percentage win is 52%. It's above 50%, but it's close to 50%. And that's real trading. I mean, that's really trading, let's say you were completely a chart nut and you only trade certain setups, you're probably looking at a 50 to 55%, maybe 60% win rate. But what's more important is the average risk reward ratio, which in this case is, for all of our trades that have been put on, is 3 to 1. So over 3 to 1. So that's what makes the difference as far as, profitability over long term. But yeah, all the trades that I, take intraday, 90% of them are not patterns in play, and they're just talked about in the chat room, because in the chat room we discuss what we're doing, and probably 70% of my trades are happening in there. The other ones are, I'm on a soccer field somewhere with my kids, or I'm at a grocery store, or driving around, and I have to pull over and put on a trade because something's getting close to where I wanted it to be at. So anyway, but what was I going to say? Well, Steve, it sounds like you are dealing with a serious personal issue over there.
The building basement flooded.
So it's for your building.
Yeah, but each apartment has a storeroom in that basement.
Got it. Okay. Hold on. I'm gonna You know, it's interesting. Data flash. Oh, here we go. We got the trade balance numbers coming up. We've got Canadian US trade balance. Let me go back over here. I'll stick around for this
Sure thing.
really fast.
10 seconds.
One of the things that I wanted to mention regarding like the Canadian, the dollar Canadian, I've put a lot of attention on it. Oh shoot! Here the data just got released. Hold on.
Both slightly better than expected, but.
Hey Stelios, we can barely hear you.
I said most likely better than expected, but I don't think it's going to move the needle.
Yeah, it's not moving the needle at all. Everybody's waiting for ISM data today. So you can see the U.S. trade balance a little bit better than expected. Canadian trade balance a little better than expected, and the dollar Canadian is not moving a lot. But the reason why I wanted to talk about the dollar Canadian is, you know, I was pointing out yesterday is we're at 127% extension, very oversold. We got to get back above 130, like 15, 130.20 to get a little bit of a recovery here. But also keep in mind we have a long-term breakdown that we're dealing with the dollar Canadian, you know, because we're below a multi-year trend line. And it would need a lot of work to turn this thing around right now. But that's not saying that it's not doable. I'm just saying that you know, to take some of this downside pressure off, we're going to have to see a pretty substantial move, you know, back above like 130, 150, which obviously is not going to happen ahead of the Canadian jobs report, which will be on Friday of this week, because on Friday we have not only non-farm payroll, we have Canadian jobs report as well. So good morning, Stelios. Good morning, Steve.
Good morning.
Good morning.
Hello, everybody.
Coach. Anyway, hope you guys are doing well. Stelios, I know it was a holiday in Greece yesterday. You know, Steve is an animal. He works right through holidays. I don't know what your problem is. No, yeah. I'm joking. I understand when
lazy bastard.
Yeah, he's lazy. It's just no. I understand when you have you know, there's obscure holidays, and then you have, you know, your family makes plans, and you gotta deal with family stuff. So good to have you back, Steve. I hope you can fight your issue.
Yeah.
With the water.
Yeah. Let's see, you know, what kind of damage we have in the storeroom, but you know, we'll figure that out. It's okay.
All right. Well, guys and gals, I want to thank you for being here with me today. I am going to pass it over to Steve and Stelios for the next 25 minutes or so, and then you guys got to stick around for Helene. She's a writer over, I believe, Market Watch, and she's been in this business a long time, longer than myself. And she's an old school chartist like myself, where I used to actually use protractors to draw all my fibs on charts that I used to print out.
The dinosaur.
I thought I'm a little bit of a dinosaur, and she's been doing this, you know, she's been drawing out charts for years, and I think she still does. I think that's her common practice. So very, very knowledgeable person. I think you guys are going to really enjoy probably what she has to say about equities, because you guys will be able to formulate your own opinions on what you think currencies will do.
Intelligence gathering.
That's right. It's all intelligence gathering. So, guys, have a great one, and everybody enjoy today's webinar. I will catch you on the daily roundup webinar at 12:30 Eastern. Just on this, I think, Steve, can you use this webinar link?
No, there is a different link, which we tweet out as well. So let me also copy it and put it here.
Yeah, Steve will find the link for you guys. But just remember, I do a quick 10-15 minute wrap up at 12:30 p.m. Eastern. So, you know, I'll be wrapping us up on, you know, talking about what happened during ISM and kind of what to look for going into Asian trade. So you guys have a great day and a good luck today, and thank you, gentlemen.
Thank you, Blake.
Good hunting, Blake.
All right, thanks. Back to you guys.
Okay.
Hey, Steve, Stel, before you get going, I just have one question I'd like either of you to field. Do either of you know what they manufacture at the Forex factory?
Isn't it Forex sandwiches?
I don't know. I was just wondering,
I just put in the chat, by the way.
Do you get minimum wage
link
there?
For the daily roundup.
And I don't know.
I hope
where
not.
is the factory?
I hope not, because as we've had this discussion before, minimum wage is really bad for employed people.
Anyway, if you find out what they make there, let me know. All right.
Only Steve will take a joke and make it serious.
Yeah, I think that's talent. That's great.
Okay,
all right. Anyway,
2 or 3 little things I want to talk about.
Our friend here says they manufacture pips, Dale.
I want to buy a pip machine.
Yeah, you should. You should actually. They work magnificently.
Better than the cursor, I hope. Anyway.
No. The cursor is by far the best.
All right. Thank you, Ride the Curve.
Technique.
2 or 3 things I just want to briefly mention. First of all, can you hear me okay, first of all?
What?
Can you hear me okay?
I'm kidding.
Okay.
Yeah.
Blake talked about the pound early on this webinar. It got cable got squeezed up to 132. I didn't see. We were all asking ourselves in the chat room why that was. Now it's back down to 131. I mean, the thing is, we are now getting very close to the 31st of January, which is only days away now. Which is the formally the UK leaves the EU. What happens next? We have until the end of December for this is a transition period. I just want to remind everybody, you go through a transition period, and during this time, the UK should negotiate some kind of a free trade deal with the EU or whatever else they want to negotiate. So at the moment, there's how shall I put it? The no-deal Brexit scenario theoretically is still not a probable one, but it's still a possible one. So I think we're going to be chopping until we have some kind of a firm step forward from both sides. I've said this before. I do think there will be something. So a no-deal Brexit scenario, I think.
From a technical standpoint, I see a consolidation. Correcting in time, basically. Let me take the screen.
You can take the screen, yeah.
So what I see, Stelio, is the pair consolidating. Instead of correcting lower in price so much, it's mostly correcting in time, and that is likely going to get resolved to the upside. If you ask me, from a technical perspective, at least that's what I see here. So your scenario of a possible, positive resolution would bode well with, that technical interpretation, right?
Yes. I mean, there's still a lot of hurdles to overcome, so it's going to be choppy as it has been. And we've seen in the chat room, people have been short, have been long. Some people are almost always selling rallies, some others are almost always buying dips, and you can make money on both sides. But at some point there's going to be a big move either way, whether there is a resolution or not, depending on that. But that's my thought on sterling, which is not really that much of a thought, but that's just what I think is coming. The other thing we had today, Eurozone CPI, which came in at 1.3% year on year. That was up from 1%. Or was it 0.9? Let me check again.
Doesn't really matter.
Whatever. There's a lot of people saying, "Oh, inflation is ticking up." We have to remember this was all. If you strip out energy, inflation was flat. Having said that, energy obviously feeds into pretty much everything. So it is a big part of production, no matter what you're producing, pretty much.
Indeed.
But it's
even transportation, right? Not only production, but transportation as well. I mean, there is no means of transportation that doesn't use oil directly or indirectly.
Yeah. So, but it's not this jump in CPI. I think it's it's not. It doesn't change anything in the big picture. Let me put it this way. So that's with the Eurozone. And final thing, I mean, we have the situation between the US and Iran. I think stocks are taking a sigh of relief because there hasn't been an immediate action from the side of Iran. You never know what these guys are thinking, what they want to do. There's been a lot of talk and a lot of menacing talk at that. but there hasn't been anything yet, any action. So the risk markets are going to take that as a positive, and probably as long as there is nothing, probably going to continue squeezing slowly but surely until we get some kind of a event, which I hope we don't. But anyway, yeah. So not much else to talk about. Obviously, we have the situation in Australia, which is really terrifying.
It is
terrifying. And people were asking why
the scale of the fires is just unbelievable. Unbelievable. I mean, I don't know what I mean. My thoughts are with them, and let's hope for the best. But already this is like a huge disaster.
Yeah. So that's pretty much what I had in mind. Not much else going on. If something comes to mind, I'll probably interrupt you, but you can take it away, my friend.
Hey, Dillian. Nice to see you, mate. Okay, so now we've had quite a lot of volatility to start the year, and having to do with seasonality. Somebody can hope that the rest of the year is going to go follow the lead of what January has been, giving us already. So, we all made the assessment that 2020 is probably going to be a much more interesting year than 2019 has been. So far, so good. Let's hope we, continue in this direction. Now, we've had some movement, but I want to focus on a few pairs that not only have moved, but they're also about to, or are either breaking out, or they're about to trigger some interesting patterns here. So I want to start by having a look at the Aussie against the US dollar. So, we got rejected from that area of resistance. We sliced through 69.30, which we know how important it was as a level. It was enough to stall price for a couple of days, but now we've been slicing through it. And the only bullish interpretation that is left on the table as we speak is that we might be retesting this broken channel trend line resistance as support. So for the Aussie against the US dollar, in my opinion, it's either we hold here, or if we actually break through that area as well, I don't think that the technical interpretations after that are favorable in any way for the upside. So you like it to the upside. We're currently testing the confluence of this trend line and the 50 daily moving average, because both of them are at exactly the same level where we currently are. So you like it, you buy it here, you put a stop loss, a few pips lower, let's say, I guess like 50 pips lower, and then you're looking for another push to the upside. But if we slice through that and we print a lower low, then I think that probably that's it. Now, at the same time, and this is the only chart I actually showed yesterday in the chat room, because I had quite a high conviction about it. This is the Aussie against the Kiwi. It was more than obvious that it was coiling and it was about to break out of this triangle, and of course the likelihood was that the break would be to the downside, right? It would be a breakdown, because we've had a strong move to the downside, and usually when you see a strong move and then a consolidation, like 2 out of 3 times roughly, the breakout from that kind of a consolidation is in the direction of the previous move. So this is exactly what has been happening here, and the next downside support is at 1026.50. Keep in mind that at the same time we're breaking through this ascending channel, so I have to say that, and we're also breaking through this recovery trend line having to do with the RSI. So I have to say that the implications are quite bearish for the Aussie against the Kiwi. And now I can connect that to one of the questions that we had, which it was for the Euro Kiwi. So I'm going to take advantage of that and show both the Euro Kiwi and the pound Kiwi, and the Euro Aussie and the pound Aussie actually. So I wanted to go through the Aussie Kiwi first because obviously, as you see, since the Aussie against the Kiwi is breaking down, now you know which of the two pairs, Euro Aussie or Euro Kiwi, Pound Aussie or Pound Kiwi, you want to choose, depending on if you want to be long or short. So, for example, if you have a look at the Euro Aussie, here it is. If you have a look at the Euro Aussie has rebounded significantly. I was looking at this formation. You can see this ascending wedge here, which, you know, we broke down from, but we never, I had said that the line in the sand for me was this horizontal support area, which, you know, we needed to take out to also start printing like lower lows. We never managed to do that. And not only we recovered to this confluence here, the trend line support acting as resistance, perhaps the 50 and the 200 daily moving average pass from here, also horizontal support resistance area, but we slashed through it. So as you see, the euro against the Aussie is in essence in a horizontal consolidation here. So, you know, we need to see if it's going to break higher from 163.50 or eventually break down from 159. But look at the Euro Kiwi. I mean, the Euro Kiwi's rebound has been, you know, a lot less impressive. And in fact, the Euro Kiwi did break below this symmetrical triangle support. And perhaps, you know, you should be very careful here because perhaps in this case, it will just retest this triangle's trend line support as resistance and then continue lower. So the Euro Kiwi definitely looks more bearish than the Euro Aussie. So if you want to be short, obviously you're going to choose to be short the Euro Kiwi and not the Euro Aussie. Now, if you have a look at the pound equivalent pairs, so here is the pound Aussie, there it is. So here's the pound Aussie. Pound Aussie, quite a nice move to the downside after falsely breaking above this expanding triangle megaphone formation, you know, different names for the same pattern. And now we're about to retest that same trend line, which confluences with the 61.8 of this move lower. So, you know, quite an interesting area of resistance we came up across here at 191.90. So I want to see how this pair is going to react from there. And here's the pound Kiwi, clearly also not as a nice rebound as we've seen in the pound Aussie. Keep in mind that at the same time that the pound Aussie was producing a higher high, the pound Kiwi was diverging by not producing a higher high. In fact, it produced a higher low, a lower high, right? You can see it here. I mean, the high there was at 2059, while the next high was at 2042. So that was also a nice signal that we might have seen a failure, which we did because, you know, those two pairs were diverging. And we're also quite close to a resistance area here at 198.80 something. So, you know, you like it to the downside, again, you should go with the pound Kiwi instead of the pound Aussie. And, you know, being short against this area of support now acting as resistance likely is a decent risk reward opportunity. So, you know, you might want to consider that. Now, what is your opinion for a CMT? I've actually gone through the first round of CMT and I did very well. And, you know, when I find a little bit of time this year, I'm going to go for the second one. I think it's, Dillian, I think it's worth it. You can definitely do it. You need to do some studying. Each cycle of the CMT, there are 3 cycles, has about a curriculum of about 700 pages. And, you know, you need to do some studying. I mean, you know, because some things, you know, are quite theoretical. But I think you can do it, and yeah, why not? It's worth it. Economic professor Mike Hudson comments on junk economics followed. Okay, I'm going to check this out, this link out, Richard, after the webinar. When I find some time today. Steve, Palladium is a runaway freight train. Yeah, Palladium is just unbelievable. I mean, even when it produces some kind of a start of what looks to be like, you know, an impulsive move lower. So, you would expect a deeper correction. In this case, it actually did hit my first target, but I did expect for it to, make it even lower. But look at this. I mean, after it hit this target, it has put on, what is it, 2, 4, 6, 8, 9 consecutive up days, counting yesterday, and who knows, perhaps we see another one today. Now, what are possible upside targets here? You can see the extensions of this corrective move. Today, we hit almost to the pip the first upside target, which was the 127% extension of this move lower, which was at 2053.85. The next one is probably the 161.8 at 2120 almost. So those are likely upside targets. Although we see that this new high is already producing quite a noticeable divergence in the RSI here, right? You can see it. I mean, we went from like above 80 to 70 something. It would have been even better, of course, if this was a divergence with the RSI being that overbought and the next reading being, below or at 70. That would have been ideal, but it's still a divergence, right? So let's see what happens from here. Definitely, it makes no sense buying it, right? Because there is no risk reward. I mean, can it go even further to the upside? Yeah, it can. I mean, this is a runaway bull market. There's no question about it. But, is there a risk reward for you to be buying it? No, there isn't. There isn't. And I think that sooner rather than later, we should end up seeing some type of a, bigger corrective move here. Probably at some point, we're going to take out this trend line support. And when that happens, we should see a deeper correction. Okay. Because this move has, I mean, if you zoom out of the chart, you'll see that we're talking about a move that is, in essence, the epitome of parabolic, right? I mean, look at this. So, these type of moves are exhaustive. I mean, there is no chance that they can, go on for eternity. And usually, these are the type of moves that also end up producing very, very sharp corrections. So far, we haven't seen one, but, the longer we stay in such a market, the sharper the corrective move lower is going to be once it actually manifests. Okay, so that is the only thing I can tell you with certainty. Let me go through some more of your questions. UK can see that Trump is a Conan who conducts US power policy on his personal whims, no matter who he puts in harm's way, and with no longer-term plan. And no doubt the UK and the EU will make a great trade deal. So longer-term, in my opinion, pound will go to 140 and then to 150. I agree, having to do with upside targets in the pound. I do think that the vast majority of the pairs are going to be higher in a few years' time against the dollar. So I agree with that. Now, having to do with your comments about Trump, unfortunately, I don't see any big difference between Trump and the rest of the politicians. So it just, in my opinion, it just looks more exaggerated because he's not, at least I appreciate that. He's not, most of the times, you want to say that it is honesty, you want to say it's stupidity, you want to say that he doesn't care, but at least he's not trying to hide it. But having to do with conducting policy based on personal whims and short-term targets, I think, unfortunately, that's the problem in the vast majority of the countries and the vast majority of the democracies. The political cycle, in essence, you describe the political cycle, that each politician wants to achieve something that is marketable in the short term, irrespective of what is the good for the nation in the longer term. And I don't think there is any big difference between Trump and the rest of the politicians having to do with that. So, that's my 50 cents at least. Bear case is that a trade deal will take a few years, and meanwhile an unprecedented is here sooner. GBP can be argued both directions. At the moment, I agree. Pound can actually end up moving in any of the directions. Depends on how things go. And this is the only certainty having to do with pound, is that it's going to remain somewhat interesting due to all those factors that, yes, they will probably be affecting the pound for quite some time. So yeah, I do agree. And I do think that one way or another, probably the easy part of the move has already been done. I mean, the easy trade for the pound was when the market was pricing in such a high probability of a no-deal Brexit, because the risk-reward was totally skewed to the upside at that point, right? So when we were trading down at 120, the risk-reward was totally skewed to the upside. I mean, the pound could have moved lower, but there was a much higher chance that the next sharp move would be to the upside than to the downside, because the market had already priced in so much negativity that, even if the worst case scenario did manifest, I mean, okay, the pound would find itself trading at 115, but, alternatively, it ended up trading from 120 to 135 in zero time because it had to unprice all of that negativity. I'm bearish for 2020 personally. Dominic, in regards to which market are you talking about? Stocks or the pound or whatever? Oh, the pound. Okay. I would be very skeptical, I have to tell you, because I think that the next move might easily be to the upside. And, you can see here why, because what I see so far here is a horizontal consolidation. And as we saw before on another chart, there is a very decent chance that this is going to be resolved to the upside once again. Now, can this end up being like a terminal push to the upside and then see lower prices? Yeah, of course it can. But, as long as we stay above this low at 129.20, I would be very, very skeptical in taking the short side of the market. That's what I'm saying. What about the FTSE 100? Yeah, the FTSE 100 is definitely going to be affected as well somewhat from what happens with the pound, right? Because, strengthening pound is some type of a headwind. But, at the same time, it is also going to be affected, by what is happening with, of course, the negotiations, because that's going to affect what is happening with the economy in general. Now, having to do with the FTSE, the big picture here is, we've been in a period of consolidation. I mean, in essence, if you go back to this high in summer of 2017, since then, we've been chopping around, right? I mean, we posted a higher high, then we posted another higher high, but every time we did that, we also had a sharp move to the downside, posting a lower low here and a lower low there. I mean, somebody could even argue let's look at it like this. Let's give it another color. Something like a diamond formation, right? So, there is a good chance that it might be breaking to the upside. Definitely, if you see a higher high from the 7,730, that's probably going to be quite a bullish signal. So, we've been consolidating in time since 2.5 years ago. So, given the fact that previously we had an uptrend, I would be quite careful with being too bearish here, the FTSE. Okay, that's what I think about it. And even if you want to have a look at it in the shorter term, so let's look at this recent consolidation. It doesn't look all that bearish to me, right? I mean, That is a likely scenario here. I refer to how Trump ran his business, squeezing suppliers and banks via bankruptcy and saying the small. Hey, listen, I'm not an advocate of Trump. I don't think he's a good person. If that's that's what you mean, there's no disagreement there. Now, do I think that he's worse than others have been in the past, having to do with, you know, his decisions as a politician? You know, hard to say. I mean, he's bad, but were the previous ones good? No, actually they weren't. So, you know, I'm really pessimistic having to do with, you know, the political system in general. I mean, it's extremely disappointing, and you know, this is a global phenomenon. I mean, the Western world phenomenon for sure. So, you know, it is a huge issue, and I do think, you know, that there are going to be developments in the future, not so far away future. But you know, this is a different conversation. If only Trump was involved in a pyramid scheme. Yeah, you know, the Fed is involved in a pyramid scheme, so there you have it. I mean, the biggest pyramid scheme is currently from central banks, right? And, you know, politicians have been confirming over and over again. For example, what is a better indication that the financial system is a pyramid scheme when, for example, let's say the previous time we had a problem with the debt ceiling under Obama, Obama went openly and said that if we don't find a solution and if we don't increase the debt ceiling, the US is going to default. If that is not an acceptance that the whole financial system is a pyramid scheme, I don't know what is an acceptance. Because in essence, when you go out and say that, listen, the only way for us not to get defaulted is for us to borrow more money. Sorry, but this is the definition of a pyramid scheme. Because an economy that can actually perform well, a politician of an economy that can actually perform well would be like, you know, if we can increase the debt ceiling, fine. If we can't increase the debt ceiling, we're going to cut expenses, and we know that we can go by balancing our budget, because a healthy economy can balance its budget. Even Keynes himself believed that an economy should be running surpluses during good times and deficits during bad times. And now we have economies that run big deficits during good times and huge deficits during bad times. So, you know, that's a pyramid scheme. End of story.
Thanks for cheering all of us up.
Yeah, my pleasure.
And Helene is here.
Oh, okay. Okay, perfect. So looking forward to
all right, buddy.
The conversation.
Nice review. And, you know, when you start talking like that, I put all my razor blades away. So, you know, I have a predisposition for depression. You're very healthy for me. Anyway,
you know, Coach. The important thing is being a realist, but at the same time, don't confuse. And I'm not talking about you. I'm talking about people. Don't confuse a fundamental thesis with a trade recommendation, because we know very, very, very well that a market can keep ignoring fundamentals for a much longer period of time than you can remain solvent, right?
Right. I'm talking more not fundamentals, but mentals. Okay, so
Coach,
anyway,
enjoy the interview.
a mental issue. All right, Steve, thanks. Helene, it's been way too long. Looking forward to having a conversation with you.
I'm here, Coach, to help you out with.
Okay. Helene sounded very ready, and now I'm going to mute you, Helene. Good morning.
Good morning. How are you?
Good, Helene. How are you?
I'm hanging in there.
All right. Well, you know, Blake gave you a big build up, and you know, you and I are, we have to say, at least veterans, right? Or masochists. Which one is it? Veterans or masochists?
I don't know. I usually just say I'm pretty old school.
Okay. Well, you know what? In these times, the experience, because you know there are a lot of traders that have only seen bull markets. Having seen different cycles in the market kind of makes you aware, maybe sometimes too aware, and you know you have to be naive to, you know, think that things are going to continue infinitum, but you know, the last 10 years or so, 12 years they have. If you want to share your screen, I'll guide you. There's a green box that says share.
Okay.
And you
A
click
green box. I see a red thing that says
that. It's
share.
a drop-down
I got
menu.
it.
Yeah,
I
there you
got
go.
it. Okay.
And
Select
then
the
you
window or
click it.
application.
You click, it'll show the windows, the different screens, and then you select the screen you want to show.
Okay, I guess I go with screen,
Yeah.
share.
It's coming up.
Is
It
it?
almost came up.
No, we
I
have
guess-
it. We can see
You
your
have it?
browser. Yeah.
Oh,
I can see your browser.
So here,
Okay.
you
All
see
right.
my black screen?
Oh,
Yes,
yeah, got
yes.
it. Yeah.
Beautiful.
See, Helene, you're more capable of this than me. I didn't think it was working, and here it is. So if you want to put up a chart or whatever
I
is on your
will.
radar.
I will. I am technologically disadvantaged, so I'm proud that I was able to do
Oh,
this.
yeah, you know what? See? Feel the fear and do it anyway. I read that book a long time ago, so, but I'm still afraid. Anyway, Helene, maybe we could start with whatever charts you brought. I'm still not seeing a chart.
Okay, I'm going to put some up. Don't worry.
Oh, okay. All right, so 2020. Here we
Well,
are.
I guess I
Helene.
should have made them a little bit bigger, but here we are.
We could see them. So 2020, and you're showing here equity
This is the
put call ratio.
Yeah, this is the 10-day moving average of the equity put call ratio.
Okay.
And let me just do a little overview first of all. I'm going to start by showing you a lot of sentiment charts because I think sentiment is highly complacent right now in the market. And I'm actually hard pressed to find any sentiment measure that doesn't show, if not an extreme, nearing an extreme in terms of complacency. The one thing that has held me back from being too bearish here is that most of the breadth indicators are still rising. So sentiment is too complacent, but you don't really have a lot of negative divergences in the market. So until you get some negative divergences, you know, as I've been saying in my columns, what we look at is I don't necessarily have to love the market up here, but that doesn't mean I have to be bearish.
Exactly.
So
your divergences, are they momentum indicators, or are you talking about new highs, new lows, breadth, etc.?
yes, to all.
Okay.
I will review that. Let me start with the sentiment side. So we're going to start with the equity put call ratio on a 10-day moving average. And that's the blue line here. And you can see we're down actually now below the January 2018 peak. And each time, now I know everyone will scoff, but each time we've been down this far, you can see that we end up with some sort of a correction in the market. And so far, we just haven't had it. I would not consider last week a correction of any magnitude.
What would 5 to 10%, would that meet your definition?
You know, it doesn't even have to be that much. It has to be enough that it scares people to the other side of the market. Okay. Even if let's just for a second, take a look at what happened here in early December. I mean, this was not a big decline, right?
Right.
But that scared people. People were panicked. The VIX went to 20, and you got the put call ratio ran to 113 on one day. I mean, we can't even get the ratio up to 1 to 100 now. So the complacency now is vastly different than it was just a month ago, where people actually got a little scared in that 3-day decline.
What was the catalyst for that? Do you remember? Was it trade?
That was trade.
Okay.
And so, you know, I mean, could it be trade this time? It could be. I don't know what it is. I just know that right now we're a little too complacent. Okay? Using this indicator. I mean, you know, now.
Yeah, so it's hard to be long, but too early to be short.
Right. I mean, in other words, it's easier to be short when there are negative divergences. And there's like a few, as I've said, some negative divergences that you could just sort of pencil in and maybe keep the eraser close.
Okay, what are they? I'm just curious.
Okay, well, first of all, the number of stocks making new highs has begun to falter.
Okay.
We haven't had a reading. Last week on January 2nd, when we had that big up day,
Yeah.
we had 214 new highs on the New York Stock Exchange. I mean, that's sort of pathetic when you're at new highs.
Anemic
Yeah.
reading. Okay.
Even on NASDAQ, where, with their real fireworks, you were 258. I mean, we had over 300 back in the middle of December.
Okay.
So
So it is narrowing a little bit.
It is narrowing. It is
Okay.
definitely narrowing. What hasn't happened yet is the number of stocks making new lows has not picked up.
I see.
It's
Okay.
remained very tepid. On the New York Stock Exchange, the readings are still below 10, below 20. Yesterday, you had a little pickup on NASDAQ to 28, but not even significant enough to get the 10-day moving average turning up.
I wanted to ask you something because you've been around for a while, and it seems like during this last big rally we had, I'm not commenting on the companies, but did it feel like it was a dash for trash in a way because biotechs had been under so much pressure, underperforming, and then made up for it in 4 weeks? And some other groups that were out of favor, the oils have rallied, which has been, a very negative environment to be in compared to semiconductors. So have you noticed that the quality of the rally is happening in sectors that were out of favor and people just rotated out of things that weren't making new highs, like Amazon and maybe a couple of the FANGs not making new highs?
Well, I have a bit of a different view on that. To me, anything that's lagging that starts to participate, it's not negative. To me, that's broadening out the rally. The problem is when it's all FANG related. Because then it's too much money pouring into too few stocks.
Okay, so that was a bullish development of biotechs kicking in gear, and
as
the
long
Russell
as Brent is rising, there's no. That's not
the
a
Russell
problem.
finally broke out, and it was underperforming all year. So,
right, but do you know the Russell peaked back in the middle of December? Actually, about 4 or 5 days after Barron's put it on its cover.
The kiss of death.
The kiss of death.
Yeah.
And that's been a problem because when the Russell peaks, you just don't get broad participation elsewhere. I mean, even the oil stocks, look at them. How many of them, I see today, some of them are rallying, but we've had oil move up substantially in the last few days, and the oil stocks have kind of churned.
It's been, I think it used to be, about 20% or more of the S&P, and now it's down to single digits of market cap of the S&P.
Oh, yeah. I mean, I'm not big on these statistics, but didn't I see something about Apple? Apple's market cap is now larger than almost the entire energy sector or something like that?
That's what I heard.
So,
and Tim Cook looked pretty happy at the Golden Globes until Ricky turned on him, right? So, all right. So, you said there was another indicator that we could use an eraser on if we blow off again.
Okay. Well, let me come back to that. Let's go back to the sentiment here for a minute.
Okay.
So now I've got the equity put call ratio. I smoothed it out even further and taking you on a 30-day moving average.
Right.
And you can see again how low it is back to the January 2018 levels, also where we were in the summer of 2018. And look, we got a correction, and it wasn't even that low here last summer, and we got a correction. Or in the spring, we got a correction, and now you can see where it is here. That's just a lot of complacency. Let me just take you to another one of these put call ratios, and this is for ETFs. So now we're getting away from individual stocks, and we're moving to all those millions and millions and millions of ETFs that are in the market now. And here again, you can see how low this has gotten. We're back here again, January 2018, but even here, this is what we saw just before the August decline or the spring decline. I mean, you're getting pretty low here, okay?
Yeah. Mm-hmm.
I'm going to show you one more on the sentiment side. And this is the 4-week moving average of the American Association of Individual Investors, Bears.
Right, okay.
And again, you know, let's go back to 2015. Did we roll over immediately? No, but look at how we just didn't go anywhere for months on end.
Yeah.
Okay, 2018 again. And then here we are at that spring high just before the May decline. And I can take this back further and further. That once you get down here in this 22% area, you just tend to not have a lot of upside in the market until you get a shakeout.
Okay, so does that mean you only have 22% bears based upon the?
Well, it's a 4-week moving average.
Oh,
so what I'm
okay.
doing is I'm trying to get rid of all those, you know, 1 week
Noise
that look funky numbers.
Okay, all right. So a lot of bullishness by professional market letter writers, right?
Well, no, professional market letter writers, that's Investors Intelligence.
Okay.
And so this is the individual investors.
Okay.
And the Investors Intelligence numbers we're just over 59% bulls. And I always use the hurdle of 60% as, we sort of jumped the shark there.
Okay.
Because it's so hard to get over 60%. To give you an idea, the last time we got over 60% was January 2018.
I knew you were going
to say. I'm sorry, I'm wrong. Was October 2018.
Okay, leading into that melt up. Yeah.
Right into the meltdown, right into that 20% decline in the fourth quarter of 2018.
Okay, I see.
Okay, so right here, I'm going to show you on the chart. Right there, that's where we got it.
Okay, that's where we had the worst December since 29.
Right. So on October 3rd of that year of 2018, we had over 60% bulls. And prior to that, it was January of 2018. And we have just not been able to cross that mark in this rally.
Okay.
And it almost seems like just when we're about to get there, what happens is we get a down Friday or a mixed Friday. And because these are weekly numbers and they're taken from the newsletters written on the prior week, on that weekend, we just never seem to cross that level. But,
and we have NFP on Friday.
Right. And this last Friday, we had the Iran situation.
Yeah.
So we may not get there this week.
Yeah, we'll have to stop saying thank God for Fridays. It's Friday, right? So, all right. So that's pretty interesting. So, you know, the message I'm getting is we're so close, I can taste it, but I don't want to be premature.
Right.
But we're very close because you've seen these things repeat through different cycles, and they're at least flashing yellow to you, right, Helene?
Very much so. And so let me explain to you. So you had deteriorating breadth last week heading into Friday, okay? And then you get Friday where the S&P falls 23 points and net breadth is practically flat. So then you get a down day and net breadth starts outperforming. But on the up days, it can't keep pace.
What's that tell you?
Well, I'm not quite sure what it tells me. It tells me that there's very little selling on the down days, but that there's not a lot of buying on the up days.
Do you notice any kind of that pattern previously that may have been like distribution? It sounds like people aren't willing to take a stand on either side of the market right here. Sounds like the market is basically giving us the same message that your sentiment indicators are giving us, that no one wants to push either side of the market.
Well,
the sellers don't come in when they have a chance to, maybe take control for a little while. And now the buying on up days doesn't have the same conviction it's had prior.
For the last week, I would say the market has gotten fairly narrow. And so the buying conviction has gone into fewer and fewer names, which is why you see, you know, Netflix up 10 and Apple up every day and that sort of thing. And you don't see Chevron, Exxon, the oil stocks getting much love. You know, you don't see a big spread. The bank stocks, even let me take you to this. Even look at the beloved semiconductors, where I am told constantly that the transportation index means nothing anymore, even though it hasn't made a new high.
Yeah, the semiconductors are the new way to transport yourself into another galaxy.
Right, as they say, but yet everybody who says that, notice that relative to NASDAQ, you haven't made a new high in almost a month.
Interesting.
And that was yesterday. Now,
that was the leadership for this advance.
Been the leadership. Look at where the semis relative to NASDAQ bottomed at that May low.
Yeah.
Okay, this is on a relative basis. So yeah, I think the semis are important, but I can't believe that narrative about how the semis are the new transports has come about just as the semis have stopped leading.
Yeah, interesting.
And
that really is an interesting, that's a pearl, Helene.
I think the semis, obviously they're probably going to rally a little bit today. I see a lot of them are up. So if they rally and this gets back on track, then you know you're okay. This was just a little correction. Mostly this line here, I think is important because it has been in place since last summer. And so if you start to get the semis weak relative to NASDAQ, so the SOX chart can stay intact, but on a relative basis, I think if you start breaking this line, you change a pattern.
I like your creativity that you didn't have to anchor the line at say the May low or the June low. And can you explain to people that are pretty anal, I call them technical analists, how you could be creative with trend lines and how you decided to anchor it in July?
Okay.
Go ahead.
I'm gonna show you something.
All right.
If I connect these two, I get nothing. Okay. 2 lines, big deal.
Yeah. Okay. So the number of hits. So you look for it's a number of hits that are important.
It's basic geometry. 2 points make a line. A third confirms it. The more points on the line, the better the line.
Boy, I wish I would have had you for geometry in junior high. I would have done better, I think. But
so let me give you. You know, I could have done this.
All right.
And quite frankly, this orange line isn't so great because all it does is show that you had a throwback rally.
Right.
Right?
Yeah.
So
it's good to be creative. I mean, the point is, don't just draw one line. Be creative. There are speed lines. There are all kinds of different lines. And you never really know about the validity of a line until it gets tested and there's a reaction from it.
I'm going to tell you.
There's a neckline. Look at this.
I think this orange line is important too.
Yeah.
And the reason being is I also have a saying that trend lines are made to be broken.
Oh God, I thought that was mine.
And so to me, the flatter the line, the more important the line, right? Yeah. And that orange line is pretty flat.
Yeah, that is.
So if you break the black line, it's sort of call it a warning because my guess is you'll stop at that orange line.
Right.
But then it's more likely than not your rallies back to the underside of that black line fail and then roll come down. So there are 2 lines here that are very important. They all come in as on the relative basis between that 0.195 and 2.
Okay. Great look,
so that's why the semis, I think, are really something to watch. And I don't think they're to watch because they're the new transports. I think they're to watch because everybody loves them and everybody's all in on them.
Crowded.
Definitely crowded. When people start changing the rules on market adages.
That used to be good for hundreds of years.
Yeah, right.
Yeah, okay.
Okay.
All right, I like that.
So that's the semis.
All right. And
then let me go back to the breadth. So here's breadth. the advanced decline line keeps making new highs.
Yeah.
And so you can't be negative when this is the case.
Right.
If this starts to falter, it becomes a problem. Okay? And
Where's your lines on that?
One of the reasons it becomes a problem.
Oh, McClellan.
It's the major input into this much smoother version of breadth.
Where we're not making new highs.
Okay, I sort of have a view on this, and I don't think the summation index matters whether it makes new highs or new lows. I think it's the direction that matters.
Interesting.
And because it tells you what the majority of stocks are doing. Are they going up? Are they going down? And in essence, you haven't taken out these highs over here from spring, but you've taken out these recent highs if that's what's concerning you. So again, I'm not that concerned. I'm more concerned on the direction. And right now the direction is still up. However, just before New Year's, it would have taken a really horrific breadth day, a net differential of minus 2,000 on advancers minus decliners, just to halt the rise in this.
Okay.
Now, it would only take minus 200.
Okay, and back under 800, would you say that's your first warning sign of the rollover?
No, my first warning sign is when it stops going up and rolls over.
Okay.
Wouldn't matter.
That 800 level looked like resistance, and you
know,
maybe,
again, the levels to me don't really matter. It's the direction.
Got it.
And you don't want the direction rolling over, because if it rolls over, it tells you that the majority of stocks are rolling over.
Got it.
So
yeah, gosh, I remember, Tom McClellan's running and stuff now, but yeah, he was, his father was great.
Oh yeah.
Yeah.
So that's where I stand now on the market. I think sentiment is really far too complacent, bordering on giddy. I would not really quite call it giddy, but complacent very much so. However, we don't have the indicators that show what the underlying stocks are doing rolling over yet. And I do think they can, but they've been given the chance in the last few days and haven't done it yet.
Can I bounce an idea off you, because I've seen your tweets, Helene, and I know you comment on yields.
Yes.
And possibly where you're at, we're in this ascending triangle on the 10-year. There, you have the same. You have the same formation here.
So I have been of the mind that bonds are in a trading range. Okay. And when you get up in that 190 area, invariably you start hearing calls for 2%, 220, 210, whatever. Higher. And look at this. Every single time since September, they've come back down. 170 has also been a floor since then.
Right.
I have allowed in the last few months, every time I've talked about bonds, that we could come down to 150 and it's still within the range, but, or we could even go up to 2. And I still think you're not really breaking out or breaking down. I think you're still kind of within this big range. What's changed in the last few days is that now 170 has an intersection of prior lows and an uptrend line.
I like it.
And so now if you break 170, it changes the pattern of it.
Yeah. It would project to new lows. What I'm thinking is one more hurrah in the bond market, Helene, into the spring, and that may be it for yields for a long time as far as going down. So, you have the same formation there. What would you say if we took out 170?
170, I think then we go down to 150. I don't know that we get lower lows.
Okay. All right. Any commentary or feel on either the dollar or metals?
I've been bullish on gold for a while. I don't have the chart here. And right now I've got a measured target. If I use GLD, the ETF, I can come up with a measured target of about 148, 150, just off the move that we just had. And the daily sentiment indicator, index yesterday was up at 82 or 83.
Okay.
So I think if you get another push up in gold, chances are you're going to get that DSI a little too high for my taste.
Yes.
But aside from that, I would just say I've been bullish on gold. I'm not bearish on gold. I'm probably a little more neutral up here. And the dollar,
I know.
You know, I have to say, for the longest time, I've thought the dollar is just, again, like bonds, in this wide trading range, and everybody gets too bullish at the highs and too bearish at the lows. And I think I'll just stick with that for now because I haven't seen much to change that view.
Okay. Well, you know what, Helene, thank you so much. It was a great presentation, a look inside underneath the surface of the market with you, and some things for people to consider with where we're at. And I want to thank you, my trading warrior sister, for edifying faith today, and that you and Ken, your husband, right? Have a wonderful 2020, and pips fall out of the sky for you guys.
Thank you. You too, Dale.
All right, Helene.
All right.
I really appreciate you being with us today. I had a good time, and you did a great job. So thank you very much, everyone here in FACE. Remember, don't just count your pips, count your blessings. We'll be back tomorrow. Adios, good hunting, and thanks again, Helene.
Thank you.